The insiders are saying, give me it now. I want off. I want off the paper exchange. I want the real thing. That's going to funnel its way down to the retail market. Now, of course, any type of an event, whether it be a second wave, whether it be the chaos that comes along with the election, or any event, is going to exacerbate the retail demand. But in general, I would say the retail public is always one or two steps behind the big money. The big money is showing what they're doing. They're requesting delivery. They're taking it off the exchange. And I think you'll see that funnel on down this fall to the retail side, where, once again, I'm preparing for massive premiums and shortages.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest that we often anticipate. Andy Schectman, the CEO of Miles Franklin Precious Metals Investments, is with us this Friday, July 10th, 2020. Andy, thanks for joining us again.
Good to be back, Dunnigan. Thank goodness it's Friday.
We've had a lot of questions submitted by viewers ahead of your arrival because there's a lot going on in the financial markets, in our economic and liberty lives, or lack thereof, and people are really looking for someone who's close to the action inside the system in the sense of the metals industry and having some ear to the ground of what's happening there. Could you start off by giving us sort of a broad brush overview of what your impressions are of some of the major factors that are impacting on us right as we speak?
Yeah, absolutely. Well, right now, Dunnigan, I think the biggest factor is what's happened to the Comex market, and it's turned into a delivery mechanism. Most contracts, typically, as long as I've been watching this, roll over, and a very small percentage stand for delivery. It's the opposite of that right now. It seems like many of the contracts, numbers that we've never even contemplated, are now standing for delivery. It's kind of akin to calling a bluff. And that's what we see happening. It's changing the landscape dramatically because it goes from being a paper, somewhat mythological market to a real-time, show me the product, I want it in my hand market, which changes the dynamic very, very much. And if you're on the wrong side of that market, if you're on the short side of that market, when it changes from a hypothetical paper equation to a I want it in my pocket equation, things are going to change very, very quickly. I have never seen a market like this where it is now being dominated by physical delivery. And that's really changing the landscape, and I think portrays much higher prices going forward.
We just spoke with several guests, including Alistair McLeod, over the past few days, who have echoed that sentiment that they're seeing definite pressures for physical delivery on the Comex that are really putting shorts in a bind, as Ted Butler also said last weekend. So it's going to be interesting.
It's real. It's real.
We have a related question from veteran Joe, and I think this is tied into what you were saying. Over the past week, we've witnessed the spot price of silver grow, but have not seen the premiums change at all. Do you see the paper and physical silver prices further diverging in the future?
Yeah, I do. Very much so. What we're seeing is demand on the highest level. Now, as we look at what we saw in March on a retail level, yes, we were right in the thick of the pandemic. We were right in the thick of the chaos. And as we've talked about in the last few interviews, the hope springs eternal, the sun shining, people out enjoying the summer and hoping to see some semblance of a normal life again, has somewhat slowed down the physical demand on the retail side of things. Albeit the premiums are still very high, and the delivery of physical product, albeit much better than we saw this spring, isn't tremendously better at all. In fact, I was talking with a very large distributor the other day and asking him about Silver Eagle allocations. And I was told that they didn't get any last week, and nor did they receive any guidance as to what would be coming next week. Now, the assumption is that there'll be a normal delivery next week, but you know what assumptions mean. And I will simply say to you that a Silver Eagle price at $575 over spot, we would be at or the cheapest in the country, or within a couple cents of being the least expensive in America. Now, to me, that's way too expensive. These coins have averaged on a retail level $2.50 over spot for the past decade. You're now trading at well over double that in terms of premium, albeit it's half of what it was in March, but it's a snapshot, I think. And if we extrapolate it into what's happening on the Comex market, maybe a step or two ahead of the retail, the insiders are saying, give me it now. I want off the paper exchange. I want the real thing. That's going to funnel its way down to the retail market. Now, of course, any type of an event, whether it be a second wave, whether it be the chaos that comes along with the election, or any event, is going to exacerbate the retail demand. But in general, I would say the retail public is always one or two steps behind the big money. The big money is showing what they're doing. They're requesting delivery. They're taking it off the exchange. And I think you'll see that funnel on down to this fall to the retail side, where, once again, I'm preparing for massive premiums and shortages. Don't forget, so much of the supply is gummed up from half of a year of being shut down in terms of mines and mints and refineries, that I think heading into the fall, we could look at major supply chain problems in and of itself, regardless of what comes, just because of the backlog of all the product that hasn't been created, or all of the supply chain problems that were created as a result of the shutdowns at the beginning of the year. So bottom line, I think you look up above, you look at the Comex, you look what's happening with the big money. They're pulling away. I think you'll see that to a larger extent as the election grows closer, as the fall grows closer. I think you'll see much higher premiums. As I've said the last few times, this is the eye of the hurricane. It's quiet. We live through the front end of the storm. The trailing edge isn't too far away, Dunnigan. And I would say to your people and to this person asking the question, look, if premiums aren't super high yet, that's a gift, because they were as high as I've ever seen them in my career in February and March and April, albeit they've come off a bit. But to me, it's a subsidy. And with what we see coming on the trailing edge of the storm, yeah, it's a gift. And I think we'll see higher premiums, to his point.
Yeah, in fact, to underscore something you just said, we not only saw at the high end of the food chain where you saw the major off-takers taking physical off the Comex currently, but also people in their everyday lives on the street have seen their local coin shops cleaned out, a lot of online dealers, very many products out of stock, notify me later if it comes in stock, that sort of thing. So we are in a comparative sweet spot to the whirlwind we just went through in the second quarter. Right now, if people want access to physical metals, they can get them through us currently still at a decent premium, albeit higher than the last decade, but quite a bit lower than they were at the beginning of second quarter.
Exactly.
We have some questions here. I mean, I guess I'd like to drill a little bit further into this before we move on, though, because you've talked with us last time, the past two visits actually, about how you're hedging a real risk to your own business by pulling forward physical material so that you'll have something that you could potentially sell when anticipating potential for future supply chain disruptions and so on in the second half of the year. In our most recent conversations with Alistair McLeod and Doug Casey and so on, there's also concern about the stability of the banking system for the next quarter or two, and wondering what is possible for yourself the nature of the business you have is you have access to physical, and you'd like to make sure that you can get that in the hands of people who want it. People who want it, want it. So how can we make sure that is still able to happen, even if we get a banking holiday, that sort of thing, because all the ability to interchange payments, that sort of thing, are there any other hedging strategies that you're anticipating that will allow us to meet the needs of customers' access to physical if we get a hiccup in the banking system?
No. The answer is no. And that's why we're in the sweet spot. I mean, these are crazy times to even think about banks failing, the exchanges failing. But if the banks fail, if the banks were to shut down and the payment system were to gum up, or if the exchanges were to fail and we couldn't hedge our product, it creates a substantial problem. I think we roll with the changes and do the very best we can, but the answer is no, truthfully. And I guess we are at that point where there's just a whole lot of what if. And I don't really know how to answer that question, but if we can't receive payment in timely fashion, or if we can't hedge our our product, then yeah, that's a problem. And it becomes a cash and carry market for the most part, instead of one that allows us to accumulate product, hedge our exposure, accept payment in a timely fashion, and deliver. That is the market. And if that changes, then I guess it's just show me the money and I'll send you the product as I get it. But we wouldn't be able to hold large positions and hedge it. We wouldn't be able to accept payments and quickly ship it. It would change everything overnight.
Yeah, I guess you're thinking of this more holistically, which is natural for you because you have more experience at it. I was thinking about the payment side, that maybe they could do cash for money order through a non-banking, Western Union or postal money order or something like that. But you're right, there's also the hedging aspect that we use the exchanges to protect ourselves from volatility in the price while you're waiting for that money to show up.
If you use money orders, there's a law, the IRS says multiple money orders, and I think the biggest you get is like $1,000. Multiple money orders is the same thing as green cash and is reportable via Form 8300 once you exceed $10,000.
$10,000 threshold. Okay.
That's right. And so, going to a Western Union and getting 10 money orders to try to facilitate a trade and then send it by Federal Express or whatever, that is not an expedient or efficient way of conducting business. And so, one of the things that I try to convey is expediency in this market without sounding like a carnival barker. That's not what I'm trying to do. I'm just simply trying to say that if these things happen, the whole game is reevaluated. The whole game changes. What enables us to be expedient in the entire process and efficient is the way that it's all set up now, the ability to accept payment quickly, the ability to hedge our inventory, and to be able to deliver quickly. All of these things are reliant upon a banking system and an efficiently trading market. And these things are all rapidly changing. So here again, it's not just the political and the social aspects that we're talking about. It's also, I listened to Alistair McLeod's interview, and it was fascinating, and I couldn't agree with him more. Let's not forget what was happening in September, the repo market. The banks have shown their instability, and we have seen a change in the credit cycle. And with what's happening in the economy and all of the bad loans that these banks are made, it's only going to make their balance sheets more fragile and more tenuous. And so the things that he was talking about are very frightening, but very real. And these are all pieces of the puzzle that should make people think for a second and say, maybe I should not look at the premiums. Maybe I should just add a little exposure right now, because if these things happen, it's game over, at least in terms of getting product in any efficient manner.
All right. Now we have a question here about the forms. Is there a difference between the risk exposure that people have for their privacy based on different forms that they might purchase? B. Hazelton says, what silver coin or bar, 1 ounce or 10 ounce, would you recommend that has low premiums and not on a reportable IRS list? So what does it make any difference, this notion of some products being reportable versus not, or is that a misconception?
No, it's not. I mean, first of all, let's talk about what is and what isn't reportable. When we talk about purchasing, when you purchase gold and silver, if you pay with a check, an ACH, or a wire, there's never any reporting. If you pay with cash or cash instruments, as in green money or money orders, as we just mentioned, in excess of $10,000, a Form 8300 is filled out. And that Form 8300 is basically, how did you get all the cash? And for someone who has a W-2 history of enough money to support having a bunch of cash, you don't have to worry. But if you have never filed a W-2 and with any means and place an order for $75,000 in cash, and we fill out a Form 8300, you might have some explaining to do. So on the purchase side, never any. On selling, let's talk about gold and silver, what triggers reporting. On the gold side, it's easy. In excess of 24 ounces, on the 25th ounce, if a client were to sell Krugerrands, Maple Leafs, Mexican 50 pesos, or gold bars on the 25th ounce, any dealer in America is supposed to request a Social Security number and file a 1099-B miscellaneous income form on their behalf. That's it. Nothing else. Krugerrands, Maple Leafs, gold bars, Mexican 50 pesos. On the other side with silver, the reporting requirements are on selling of silver in excess of 1,000 ounces silver bars and rounds, period. Silver bars and rounds in excess of 1,000 ounces, or junk silver, 90% junk silver in excess of $1,000 face value, which is about 715 ounces. Now, people may say, well, why are those items reported, but things like American Eagles or Maple Leafs or Philharmonics or any of the coins or any of the old silver dollars, why is that stuff not reportable? And the reason is that those things used to be reported on the exchange. They used to record their prices and print them on the New York Stock Exchange ticker. And so those items were agreed upon between the IRS and the Industry Council for Tangible Assets, ICTA, many years ago, 1984, I believe. Those items were agreed upon on a handshake basis. So the industry has adopted that. Anytime someone sells more than 1,000 ounces in bars or rounds, more than 1,000 face and junk, or more than 24 ounces in Krugerrands, Maple Leafs, 50 pesos, or gold bars, we as an industry are supposed to file a 1099-B. Anything else does not require any reporting by the dealer. Doesn't mean that you, the customer, aren't supposed to, via the honor system, report when you sold something. So that's how.
For potential capital gains you're talking about.
Yes, sir. Correct.
Now, there's been some questions about that. On those capital gains, there's short-term, long-term, and when people are dealing with stocks or whatever, there's different rules for different things. Stocks, your house, and now what about metals? Are there some metals that are considered collectibles, therefore they have different reporting rather than ordinary bullion, or is it all the same for metals?
All the same, 28% collectible. Interesting, even if you sell the GLD and SLV, the gold and silver ETFs, it's a 28% collectible rate. But what that also means is, you mentioned a house. If someone were to sell a house, and let's call it an investment property or a second home, and they have a capital gain, you can wash the capital gain of one investment, like a house or a stock portfolio, against a precious metals loss of 28%. And those numbers, there's a slight switch that your accountant would be able to figure out for you. The 28% collectible would wash against the capital gains of a stock portfolio over a home. The only thing is that there's a little bit of a switch that they have to factor in, but they all do wash off dollar for dollar, but it is at the 28% collectible rate.
Interesting. We have a question here on platinum from Anon Who Cares. Andy, could you give me your 30-year outlook on platinum? I believe that I will live on the profits of my silver. My children will inherit the conversions of gold, and my grandchildren will inherit the platinum I presently acquire.
Yeah, it's the same argument as silver. It is grossly undervalued in relation to gold. It's 30 or 40 or 50 times more rare than gold. And it's unusual. It's an anomaly, just like silver is to gold. It's an anomaly. The value you get in platinum is extraordinary. Trying to find it in this industry at a decent price is also extraordinarily difficult. And the mints, the U.S., the Canadian, the Australian, have proven to be the model of inefficiency as it pertains to printing, or minting rather, platinum coins. Tiny bits, and the premiums are very, very high. It's an intriguing investment. To me, it doesn't have the same properties that gold and silver do as really a monetary investment. It's more industrial, and its uses are in catalytics. It doesn't change the value proposition. For me, it's a tertiary metal to my portfolio. It represents a much smaller percentage than does gold and silver. The logic behind the question is very sound. I can remember, I think it might have been 2008. Gold was $850. Platinum was over 2,000. Most of my career, it's always been at a premium of 10% or greater to gold. The fact that it is as undervalued to gold as it is shocking, and maybe even more so to palladium. So the mathematics behind it are real, and for that, I would take a stab at it. But I would not go real heavy into platinum because of the unknown. I think that when the world gets afraid, they move to gold and silver. To me, platinum represents an investment opportunity, but I wouldn't use it as the cornerstone of my wealth. But yeah, it's what he's saying makes sense, and I buy it.
The next question I'd like us to get into, and maybe we can treat this a little bit thoroughly, and that's for international clients who either don't live in the U.S. or would like their metals stored outside the U.S., and then we can get into storage next. I think that's something that just keeps coming up. Sabertooth says, thank you both so much for exposing central bank manipulation of precious metals. I am in Vancouver, Canada. Can Andy and Miles Franklin help me purchase and store precious metals in Canada? So can you talk to us about people who live outside the U.S., what considerations do they have in order to make sure, yes, they can or no, they can't purchase precious metals from us or within the U.S., and then how we can get them to them?
Sure. Well, it doesn't matter where you are. There are no restrictions of purchasing precious metals, as far as I know. I mean, we ship all around the world. Many cases, once you go into Europe, you have VAT taxes on silver importation in almost every country. Never the case with gold, and 24 karat gold is always seamless. It's the cost of shipping it there that can often be a problem. As it pertains with Canada, we have some North American exclusives with Brinks that we're very proud of, including in Vancouver. Vancouver, Montreal, and Toronto, we have some exclusives with Brinks that allow us to store in those Brinks depositories on a fixed rate basis. No one else in North America has that ability. In other words, the highest cost component in storage is insurance. And that's why almost every single, at least every one that I know of, storage contract is based on a variable rate structure, meaning as the price of the metal goes up, so too does the cost in which you're being charged. Not the case with our program in Canada, including in Vancouver. We have a fixed rate program. So you're betting on the come, if you will, in the respect that the higher the price goes, your storage stays the same. Everyone else's goes up. We also have a safe deposit box program in Vancouver, Canada, another North American exclusive, whereby we have the only safe deposit box program fully insured in a non-bank facility, that being in a Brinks facility in downtown Vancouver. So to answer your reader's question or your listener's question, yeah, absolutely. We can send it up to Vancouver with no problem whatsoever. In fact, we can even have large amounts delivered for free by the Royal Canadian Mint directly to Brinks Vancouver, whether it either be in a segregated account, if it's large amounts of silver, or a private safe deposit box where these are brand new state-of-the-art safe deposit boxes where the client holds the only key and the only spare. They are one key boxes. For those in the United States, those boxes are, according to the IRS, 100% non-reportable. In fact, they've come out in print on Form 8938. In fact, I think the Google entry would be Basic Questions and Answers. Form 8938 takes you right to the IRS website, where you will see they said very clearly, precious metals directly held outside the United States in a non-financial institution are not reportable. And the only time they have ever given an explanation as to what directly held was on that form where they say an example being a safe deposit box in a non-financial institution. And that is what drove us to opening the safe deposit box program. Now, as a caveat to that, I would also say that I do believe that a fully segregated and audited account in a facility, non-financial institution like Brinks, is also directly held, albeit the IRS has never explicitly given that. They said an example, not the only example, being a safe deposit box. And therefore, in our program that holds silver and gold that aren't in the safe deposit boxes, we employ a tremendous amount of redundancy in segregation and allocation in terms of internal audits through Brinks, external audits through a company called Inspectorate, and Miles Franklin staff. Now, there's been a little hiccup with that, of course, with COVID. We have not been able to get across the border to conduct those audits, but Brinks still does weekly internal audits amongst their staff. So, yes, sorry for the long-winded question. The answer is yes, we have no problem sending it to Canada and providing storage that is really second to none, in my opinion.
I guess for any international client, though, there may be different shipping fees, and it has to be estimated based on their actual product ounces that they're purchasing and how far they're going. There are some considerations on how they can avoid the import and excise tax or whatever on their individual customs at their country. What are some strategies to help around that?
Well, again, it just has to do with what is and what isn't excised. Typically speaking, if it's 24 karat gold, there are no taxes to worry about. Silver, you're going to have a import VAT tax. We have an import-export license, which will remove the majority of those taxes that you're talking about. It only would speak to a VAT tax if that item was taxable. Typically, the way that it works would be a client would email us, are we able to send to you? I ask for an address and what they want. Or are you able to send to us? I ask for an address, what they want. We get a UPS quote based upon the product that they're ordering or want to order, the value that it encompasses, and their address. And we can tell them what that shipping quote will be. In terms of a VAT tax, it's pretty cut and dry. If it's 24 karat gold, you don't have to worry. If it's silver going to Europe, you pretty much have to worry and expect there to be a VAT tax applied.
We've been talking about international shipments, and you talked a bit about Canadian storage. What about U.S. storage options for people who are, maybe they're living in the U.S. or they just want to store their metals in the U.S.? What options do we have for them?
We're very proud to announce that we have now brought our Canadian storage program, which is 8 years old, our very successful Canadian storage program, into the United States. Brinks has allowed us to bring those programs south. We are now introducing the exact same rate structure here in North America, the only ones that have been given this I don't know what you want. They've allowed us to carry forward our fixed rate structure into JFK in New York City, into Los Angeles, and into Salt Lake City. So we have the ability to do a fixed rate structure, second to none, in those three facilities. And so we're very proud of that. In fact, we just launched those last week. So for people who want to store in New York City, Los Angeles, or Salt Lake City, we can now store not only 24 karat gold and silver, but we can also store numismatics and in a fixed rate structure, which is second to none. I'd like to mention real quick in terms of the silver side of things, the rate that we have on silver is, with silver going higher, we are right on the cusp of in the fixed rate of it being a value proposition or maybe paying a little too much. Our silver rate structure starts at about roughly 75 basis points where we are right now, which puts it a little bit higher on large volumes. So we have in Salt Lake City a high volume or a high value account that allows our clients to put large amounts into Salt Lake City at the lowest variable rate in the nation. Once silver gets above $25 or so, our fixed rate program literally is second to none and will be the envy of the industry and unbeatable because it cannot be beat. As the price goes higher, you stay fixed. So we've kind of found a middle ground and a way to handle all levels of clientele. But I'll simply say this: once the price starts to move, and we expect that to happen, once that price starts to move, our fixed rate programs in North America really will be second to none in the respect that no one else has been given this honor from Brinks. And as the price goes higher, we will be the lowest in the industry, bar none.
The next questions have to do with, and there's several of these, I'm just going to lump them all together, about buybacks from clients. If people have metals that they'd like to sell back, or maybe they're anticipating purchasing metals, but they want to know, are you going to stand there and be ready to buy those back from me in the future? So several questions, you can hit them all, I think, together. One is people asking, do you only buy back metals from those who have purchased them from you, or do you buy metals from people who got them no matter where they got them from? Secondly, do you buy gold back, not just silver? And thirdly, when people have purchased metals in the past and want to sell them back in the future, they know there's going to be the bid-ask spread that they're going to not get the advantage of. But what about premiums that can have shifted along the way? So what's the value equation to help people guide them and whether they're going to come out ahead when they go to sell back? So if you can kind of just look at that whole area of buybacks.
Yeah, absolutely. Well, we always provide a two-way market, and we will always be happy to buy back from people, whether they bought it from us or not. We will always give the highest bid price in the country to those people who bought back from us, and most likely from those who didn't buy from us. The premium does follow on both buy side and sell side. Bid and ask, that premium will follow. And as we saw in February and March, and April, as the premiums were skyrocketing, we would have been happy to give those high premiums on the buy side too. The only thing was that nobody was selling, which typically identifies a gold bull market. The higher the price goes only reinforces people's concern for owning it to begin with. But yes, we buy everything back from the public. We have all the sophisticated machinery to detect frauds, and a lot of people have been talking about the fake bars coming out of China. These are real concerns for some people. So we have all the sophisticated machinery that guarantees that what we are receiving through our intake process is indeed legitimate. But yes, we will buy back from anyone, and those premiums will, at least if they don't from a company you're working with, then you need to find another company like Miles Franklin who will carry those premiums to the buy side too. And quite frankly, I do believe, Dunnigan, that this market will be defined by massive premiums and an inability to source product. My whole career has been preaching to the choir until recently. And I can tell you that most of my public speaking prior to me meeting you centered around inability to source product in times where it shouldn't be, where it's just the choir asking for product. And typically in October or November of almost every year in the 2000s, there was some sort of a supply chain problem coming out of the five major mints. They would shut down, they would run out of product, etc. And it always made me wonder if we're just the pimple on the elephant's rear end, those of us who are accumulating gold and silver, why do the mints run out of product? And it really shaped my thinking. And quite frankly, once the public jumps on board in mass, as I expect them to do, once the realization that this is for real, it will define the market. In fact, I would argue it will be the defining characteristic of this market, not even as much by high prices, which everyone will notice, but by the inability to source product at a decent price and easily. Because when those five, let's call it six major mints run out of product, US, Canada, Australia, Austria, South Africa, and to a very small extent, Great Britain, it's game over. That is it. When they run out of product, that is it. Because in an escalating market, I'll tell you, we did more business in the past few months through the beginning of the year than we did all of last year. And through that, and you can attest to this yourself, there's been maybe a dozen people selling, and we've done thousands of orders of people buying. No one is selling. So where does the product come from if the public isn't selling and the mints run out? Question is, there isn't any. And we've seen it repetitively. And quite frankly, there was a time in 2008 when there was no product. And I was very concerned that, we'd go out of business because we had no product. The mints wouldn't allow us to sell any. The refineries were out of product. And the secondary market was doing nothing but begging for things to buy, not sell. Key point that is often overlooked, and maybe the most important thing we're talking about here today, is that, when we go to the grocery store, we expect the shelves to be stocked. I envision a period of time, honestly, where you're looking at bare cupboards in the precious metals industry because, we are a very, very small minority in terms of financial assets. And when the realization comes to Main Street that they need gold and silver, we will be in strict competition with big, big money. That's price inflation. And I think you'll see lots of money chasing fewer and fewer goods, and it will define and shape the marketplace, in my opinion, for everyone who's looking closely.
Yeah, I think to put some numbers behind that last statement that you made when we spoke with Rick Rule about a month ago, he said that back in the peak of the 2009 to 2011 run-up in gold and silver prices, gold and silver and related equities took up like 8% on average of people's portfolio across the board. And today we're at like 0.5%. And that the mean for the past like several decades is like 4% or 2.5% to 4%. So we'd have to revert 4 times the current rate to return just to the average, let alone to overshoot in times of a rush.
If we saw a 4 to 5 time increase in demand, it'd be game over in this market. It already can hardly handle what it is. And because of people like you and your efforts of getting the word out, people are waking up. And I would define what's happening right now as a great awakening. We have 1,500 new clients since March. That's unheard of in this industry. So many of them have never held a gold coin before. So many of them are for the very first time feeling things are different. And they're looking for a way to protect themselves. And as we've talked about before, those people very often would have been instructed to move to the bond market. With interest rates where they are right now, they're not going to the bond market. They're coming here in a period of time where the supply chain has been tenuous at best. If we see Any event, pick any event in your mind's eye, and the supply chain breaks again and people start rushing. I'm talking a period of 24, 48, 72 hours. There's nothing left. And that's how quick it happened in March, whereby all of a sudden, well, let's look at the US and the Canadian Mint as an example. In both of those cases, we had orders, substantial orders placed in total of $2 million and orders placed. And normally, when we work with the Canadian Mint as an example, we place an order for $2 million. It's on a truck and in our warehouse in 10 days, max. In both of those cases, we placed the order. It was confirmed. The product was on the floor. It wasn't even being produced. It was ready to go. And boom, the mint shut down. And now what? I got nothing but angry people saying, why do you sell stuff you don't have? But that's what we always do. We always sell stuff because it's ordered, it's on its way. That's how grocery stores work. That's how everybody works. Of course, the grocery stores don't sell stuff that they don't have because it's not on the shelf, but they buy things in anticipation of it. For us, we buy things in anticipation of it. And as far as we're concerned, it's on the shelf because it's always worked. It was an eye-opening experience this last spring because of that, because we bought things. We assumed that they'd be on our shelf ready to sell, as they always have, and they shut down due to COVID. And when that happened, we had angry people and we had weeks and weeks of unknown when we'd get our product. And it actually took months to get it. It was an eye-opening experience. And that is why we are trying our very darndest to load up on product in anticipation of this fall at the highest premiums that we've had to pay, save, for example, February, March, and April. But in general, at the highest premiums we've paid in a decade. And we're paying those premiums right now, loading up on product in anticipation of this happening. And so, quite frankly, yeah, I think that supply chain problems, sourcing product premiums, these will really be a problem, if I'm correct, heading into the end of this year.
Something you mentioned in passing there was the awareness, the awakening awareness that people aren't going to be getting from their traditional financial advisors or financial planners who have in the past just said, yeah, if you're worried about risk, just roll out of stocks and roll into bonds and you'll be good. Some people are still getting that advice because that's the only script that the financial advisors were taught. That's the only one they know. I had a very interesting experience in the past week. A young client, young independent business owner who was wanting to make sure that she's got her future covered and saving towards potential future retirement, came on, and actually we met over a period of 3 days, and the last day she even brought her financial planner on the line, and we talked together, and I was delighted to see what seemed like some genuine openness and interest on the part of the financial planner, because I've and my wife have attended several retirement planning seminar type things, and the standard answers that you get is, yep, you just cost average into the stock market and it goes up 7% per year over your average, and you have this blend of stocks and bonds. And I asked enough uncomfortable or inconvenient questions to kind of get the body language that I should quit asking questions at those seminars.
Mm-hmm. I'd like to talk about that too, because that's a great point. First of all, I'm going to make a kind of a blanket statement. To me, many financial advisors, not all of them, but lots of them, learn more and more about less and less until they know everything about nothing. It's a situation where these people have a closed eye to alternative investments. When I started in this industry in 1990, these people were called stockbrokers. They weren't called financial advisors. I was, at one point, a financial advisor many, many, many moons ago. I've gone through the whole gamut of Series 7, Series 25, etc. But let's just talk about that for a minute. As a stockbroker, you make money on a trade. At least they did. You would make a percentage of every single trade. That was before the internet. And when the internet came and companies like Scottrade got on the scene, and would do trades for $9 instead of 1%, stockbrokers immediately became obsolete. So what did they do? They became financial advisors. Now, the difference between a stockbroker and a financial advisor is one test. I think it's the Series 25, I believe. It's been a long time since I took it. But it's 100 questions basically on how or how not to screw somebody. It's all ethics, Series 25. And it's not a hard test to pass at all. The Series 7 is. The one that allows you to become a financial advisor is not. So basically, you have, if we want to just boil it down, I mean, I can think of a lot of my friends who were like mortgage brokers in '08, and when the subprime deal hit, mortgage brokers all dissipated, and I can think of 2 or 3 of them that became financial advisors. Well, are they qualified to be a financial advisor? No. They passed a Series 7 and a Series 25. They became financial advisors, and they're not qualified to be a financial advisor. In other words, we put too much stock in a name. A doctor, a lawyer, a dentist, people who have to go to further schooling to earn their title, well, that's one thing. But in general, a financial advisor is just someone who passed a GED or a high school graduate who passed a Series 7 and then a Series 25, and now they're an advisor. There is no 2-year postgraduate degree for financial advisory. And so in general, financial advisory is it's hit or miss. You can find a really good one who will have an open mind, but many of them don't and will not. And the biggest reason is this. If you remember, a stockbroker made money per trade. How do financial advisors make money? They make money by keeping you under the umbrella. And if you pull assets out to give to you or I to sell physical gold, well, that money is now off their plate. They're never going to make money on that again. It probably won't ever come back. So they find reasons to tell you, well, you don't want physical gold, the storage and all the risk and all that. Buy GLD or what have you. So the bottom line is simply this. You have to be your own financial advisor. You have to trust your gut, because most financial advisors will not recognize the benefit of buying physical gold because it takes money off their plate. Now, I'm making a general statement. I know many financial advisors who are open-minded and objective and will see to it that their clients have an allocation of physical metal outside of what they're doing. But more often than not, you're going to find an objection or a wall or an inability to convey your beliefs to your advisor, because human nature is such that they don't want to lose money on that decision. So, trust your gut. It's your best financial advisor in these times of uncertainty.
Yeah, one of the aspects that came into the conversation quite prominently when the 3 of us were speaking together, me, a client, and her financial advisor, was the concept of diversification. That's something, it's almost a religion that people have been told to diversify as though it were a goal in and of itself. And I had to press the point a bit just from a logical standpoint, because coming at it from an engineering, my background is in engineering. We talk about failure modes of analysis to reduce risk, and diversification is just a strategy towards a goal. The goal is risk reduction. The goal is loss prevention, or the goal is potential gain. Hitting gains rather than trying to guess the one thing. You can guess one of any, and you'll get a gain. So it's a strategy, and with the most insidious part of it in today's economic environment that we talked about was that there's the appearance of diversification. If you say, well, I'm going to go into the S&P 500, that's 500 different companies, or the Dow Jones Industrial Average is 30 different companies that I'm buying the stock in, or I'm going to buy some foreign stocks, or I'm going to buy some bonds and some stocks. And more of the experts we've interviewed here are saying, guys, you don't understand. All of these different stocks in these different companies are being propped up by buying by the central banks. They're being artificially inflated by unnaturally low interest rates. The bonds are moving in parallel with stocks, and rather than being a hedge against them, because they're also being bought by the central bank. So it's all floating on the surface of this stretched bubble. And if the bubble pops, this apparent diversity just disappears. And the question is, how do you get off that bubble? How do you not be in that casino?
Well, first of all, diversification, in my opinion, is a tool or a term made up by financial advisors to mitigate risk. To me, the way to succeed is, well, if we talk about a real diversified portfolio, it's a sampling of several asset classes, most of which don't move in unison. Some move up, some move down, some move sideways. You're the best of the worst, or the worst of the best. You're mediocre. To me, the way to succeed in investing is to identify the primary trend. My mentor in many respects is Richard Russell, and he always talked about the primary trend of the assets, like the way the river flows. To me, the way to succeed is to identify the primary trend, and instead of being broadly diversified amongst several asset classes that are not moving in unison, You identify the way the river flows, the primary trend, and you jump in with both feet and you broadly diversify within it. In this case, gold, silver, platinum, palladium, mining shares, oil and gas ETFs, farmland, agricultural ETFs, anything that you can do opposite the dollar to broadly diversify opposite the dollar best you can instead of being broadly diversified. And so I think that diversification really is not the way to do it because that just gives you mediocrity. If you want to succeed in investing, you first identify the primary trend and then as best you can broadly diversify within it. And so you're right. I think that when you talk about stocks and bonds, traditionally they were inversely correlated. They aren't inversely correlated anymore. And as interest rates rise, they both pop. So, yeah, I think that you have to look at things a little bit different. We are entering a new phase where traditional forms of investing have to be reevaluated. And I think you have to more than anything else is take a step back and in your own mind's eye determine what is the primary trend. For me, the primary trend is of a denigrating dollar and a increasing value in precious metals. And unfortunately, the alternatives are few and far between. And I think at this point, this juncture, being broadly diversified, when they all come back to the dollar, is going to lead to a lot of disappointment and shock that their portfolio indeed wasn't as diversified as they thought. Because whether you have a whole sampling of stocks across the whole S&P 500, if the S&P 500 collapses, in fact, if you look at the S&P 500 over the last 2 years, what you see is massive up and down. But if you draw a line across the top, it's gone nowhere. And over the same time period, last year and a half, gold's up almost 50%. So the big money, the central banks, have been massively accumulating gold and de-dollarizing, and that does not bode well, I think, for our stock market. So, yeah, I think that time to reevaluate what diversification really is.
Last chance before we leave to tell us about, you just recorded a main stage presentation for the Sprott Virtual Natural Resources Symposium that's coming up later this month, the 22nd through the 25th. As you look forward to the Sprott Symposium, what are your main thoughts?
My main thoughts are things are moving in hyper speed. And every day we are seeing so many things happen that are changing the landscape. I think the bottom line is simply this. People need to take a step back, reevaluate, and start to shore up. The big money is moving away from dollars. The big money is moving into precious metals. The big money is pulling metal off of the exchange and taking possession of it, shoring up as we move towards the election. For those people who have never been to the Sprott Symposium in Vancouver, you have the finest minds in the world, a lot smarter than I am, there giving their take on what's happening. I think this might be the most important show they've ever had. It's sad that it has to be online instead of in person in lovely Vancouver, which might be my favorite city in all of North America. But I think it's really important people listen, from Rick Rule to Doug Casey to Bill Bonner to Jim Rickards to you name it. It's something that most people should listen to, because you're going to get a whole different perspective than you'll find from your financial advisor. And the smartest minds in the world, the smartest economic minds in the world will be at that show to give a take. But Dunnigan, I see things changing. I feel things changing. And for the very first time in my 30-year career, I see the wolf is coming. And we've been calling wolf for a long time, and we've been wrong. We've been wrong that the wolf is coming. And, but I think when you base your opinions upon economics and mathematics and logic, eventually they play out. But these are high-stake games that have high consequences. And so, they may not play out the way we all think when we think, but in the end, I think mathematics and logic and economics win out. And that's what you'll hear about at the Sprott Symposium. And I think that's what we're going to see happen the second half of this year, kind of a reevaluation of what is value and a reevaluation of what is risk and a reevaluation of what are sound assets. And all of that you'll find, I think, very succinctly from a whole different gamut of speakers and perspectives at the Sprott Show. I urge everyone to jump online. And this year, you don't have to get on an airplane and buy a hotel at the Fairmont in downtown Vancouver, all of which are costly. This is an opportunity to see the best and the brightest from the comfort of your own home.
Yeah, folks, you'll find a link in the description of this video to get registered for the virtual Sprott conference, and you'll see sneak previews interviewed by myself with a number of these speakers, in addition to Andy Schectman, Doug Casey, Jim Rickards, Nomi Prinz, Danielle DiMartino Booth, and others this next 2 weeks leading up to the conference. So that'll give you a taste. They're going to give us some hints of what they're going to be talking about there, but if you want to get the full deal, just follow that link in the description of this video, get signed up, and we'll see you at the conference. So Andy Schectman, CEO of Miles Franklin Precious Metals Investments, thanks for joining us again here on Liberty and Finance and Reluctant Preppers.
You stay well done again. Great to see you. Hope to see you soon.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.